If you don't mind, to get us started before we get into the nitty-gritty of macro, could you share the story of how you got started in investment business?
Yeah, I studied math and philosophy in college without any idea what I was going to do with those degrees. I just took it because I liked it. And I ended up getting, when I got a degree, the philosophy is not worth much of anything in the real world, but math has some applications. And the applications tend to be an actuary for an insurance company, a math professor, or code breaker for the NSA. And I refused to do anything with the Defense Department. And I thought that I would just have to make some money. I took this job at an insurance company, and I absolutely hated it. I was living in Hartford, which was a big part of the discontent, which was in those days, it was a terrible place. And I just hated the company I was working for. And so I figured, I'll go back to school. And so I got into a PhD program at Yale. And I learned very quickly that was a dead end as well, because you would be a professor. I thought that a professor would be a very idealistic, good place to be without a lot of politics and all the stuff that goes on in business. I was so wrong. It was the most political thing ever. So I left that and went back and decided I was going to play rock and roll. So we came to California, and I was in a rock and roll band to some minor success. We did open for Guns N' Roses, but before they were famous. So it's not as impressive as it sounds. So I got a job finally because I needed money, and it was at an insurance company at Transamerica. And weirdly, I actually sort of liked it. It just wasn't that bad. But I knew I was going to have a career there. It's just I didn't hate it. I was actually okay with the business world. And so I was living in Hollywood. I was still playing rock and roll at night. And I had this crummy one-bedroom apartment in Hollywood. And all my stuff that I had was given to me by friends. So I had like a beaten-up chair, I had a cardboard box for a table for the TV, and the TV was a black and white TV, which was completely antiquated. A black and white TV, the knob for changing the channel had fallen off. You had to change it with pliers. And I used a wire hanger as the antenna. And in those days, there were really only 3 stations, the ABC, NBC, CBS. And I turned it on one night randomly, and there was Lifestyles of the Rich and Famous came on, which is that show by Robin Leach, Champagne Wishes and Caviar Dreams. And they said, we've a special show tonight. We're going to count down the 10 top paying professions in like America. And so great, I'll watch this thing about top paying professions and I'll figure out what to do. And so actually actuary was number 7 on the list, which was kind of frightening. But then when they got to number 1, they said, number 1 is an investment banker. They said, you have to work really hard and you have to have a very analytic mind. And I said, I got both of those things. So I decided I was going to be an investment banker that at the end of the show. And so I went to the closet where I had the LA Yellow Pages. And I decided I was going to look up investment banker and apply for a job. Spoiler alert, investment bankers do not advertise in the Yellow Pages. But I didn't know what an investment banker was. So I looked up investment, and there was investment management. And I figured that sounds like the same thing, so it's close enough. So I looked at every firm that had a boldface ad in the Yellow Pages, and there were about 25 of them. And I just sent every one of them a resume with an aggressive sort of cover letter. And I got 3 responses. One was, you've got to be kidding. You have no background in this whatsoever. The second was, we could use a mathematical person like you, but we're a 2-man shop and we can't pay you. So that was off the list. And the third one looked like the college admissions rejection letter. You know, that little tiny thin envelope that you kind of know what it's going to say. And I threw it away. But that evening, the curiosity got the best of me, and I went to the trash, fished it out, and opened it. And it was very short, and it said, we have had a large response to our job posting, but we're willing to talk to you. Call this number. I'm like, job posting? So at pure luck, they had posted a job opening at UCLA, unbeknownst to me. And so I got this interview. And I go in there, and I meet this guy that's doing the hiring. He was a pretty senior guy at the company. And he said, well, your background is really interesting. I mean, you certainly have excellent academic history and all that stuff. So I have a question for you. Do you think you'd rather do fixed income or equities? And I kind of froze, and I looked at him, and I said, I don't know what those things are. And he kind of rolled his eyes, and he said, equities, stocks, fixed income, bonds. And I'm thinking to myself, I don't know what bonds are. So I said, stocks. And he goes, well, I actually think that we could use more help with your quantitative firepower in bonds. And so I got hired on a 90-day probationary basis for $30,000 a year. And I spent the week in between quitting the insurance company job and starting there by reading this thing called Inside the Yield Book, which was kind of the Bible of fixed income. It spoke about reinvestment and how that worked. And it started out with prose at the beginning, like essays talking about bonds. And then the second half of the book was formulas, bond math formulas. And I figured that I would learn a lot and get a deep understanding by deriving the formulas from scratch myself, because I was just out of the Yale PhD program in math. So I go and I start working, and I was so naive. I thought everybody could do that. I thought everybody knew how to derive bond math formulas and stuff. And I learned within a few days that I knew more about bonds than the people that were doing it, because they were just a placeholder. Back in those days, money management was largely what we called balanced funds. So you had stocks and bonds, and the same company did both, and they would allocate 60-40 to 40-60 or whatever. And the bond guys were just kind of, a sidecar. It was all the equity guys that were driving the bus. And so the bond guys were they were just a placeholder. It was almost like being a clerk. And so it turned out that I learned very, very quickly. And within 6 months, I'll cut the story short, I go on for about an hour, but after 6 months, I got the Chrysler pension plan that I was tasked with managing, primarily because the guy who should have been doing it was afraid that he'd screw it up and he'd get fired, because the head of the company was friends with Lee Iacocca. And that's why we got the account. It's because of this, almost nepotism sort of situation. And so I started doing it. Thankfully, it wasn't that hard. It wasn't full-on active management. It was more of a formulaic mandate that we had. But it turned out that I was their best manager. And so I started doing mortgage-backed securities, because that was by far the most interesting market. It was rapidly changing. It had just come into existence, really. And there were so many things going on, and it was really a fertile place for excess return. And as luck would have it, I ended up having the highest returns in the industry. And I remember people saying to me, how could you do this with mortgages? But it was because they were so incredibly inefficient. There were really weird things in the market in those days. There were quarter coupon mortgages. There aren't anymore. So they had Ginnie Mae 10s, 10 1/4s, and 10 1/2s. And for some unknown reason, the 10 1/4s traded below the average price of the 10s and the 10 1/2s, which makes no sense. Right. It was just because there was something about it was an off-the-run coupon or something. So there were weird things like that you could do. It just shouldn't exist. And so I ended up doing more and more and more. And what if you're ever really good at anything, it's almost a guarantee you're going to get fired. And so I started DoubleLine.
Well, that's a good segue. So thanks for that, Jeffrey. I especially like the lifestyles of the rich and the famous component there. With that, we'll jump into a bit of the macro discussion. There's a lot to focus on here, but just sort of starting, figure we'll talk for a second or a couple minutes about the economy, inflation, and sort of jump into investments. But I remember, I think the last time we did this was probably maybe February last year, and there was a lot of discussion back then and all of last year about the potential for no landing, soft landing, hard landing. And the probability of a recession was, I think, around 65% for much of last year. Today, it's 30%. And the market still believes the Fed is going to keep the Fed funds rate pretty close to where it is now. Why do you think that we didn't have the recession that everyone assumed, the most expected recession ever? Why do you think that?
Yeah, I think we can all agree that the answer to that is the lockdown and the stimulus, which created an economic pattern and new variables into the economy that made historical cycles less of a template for maybe what was going to happen. And so, we have the inverted curve. I think Bill showed it, or it was slipped into his thing.
Those are our slides. Everyone saw them already.
Right. So the curve's been inverted longer than any time in my long career. And yet it's been very, very stable for a while now. They haven't changed rates for quite some time. It was last July, I think, was the last hike. So we're coming on a while on that. And so the inverted curve would strongly suggest that we should be in recession. But money supply, I think, was the biggest head fake of the whole thing, because the stimulus of the trillions of dollars took the money supply trajectory of M2 from an incredibly stable growth pattern for the years into the lockdown, just very steadily, and then all of a sudden, like this. And then the heavily monetary policy and monetary looking economists, they always observe that when M2 goes negative year over year, you get a recession kind of like immediately, almost always. And so what I think the monetarists missed is that the M2 did decline year over year, but it was still really high. It was one of those things where people got fooled by year over year and didn't think enough of how about versus 2 years ago, 3 years ago. And frankly, there's a lot of stories out now about excess savings have been used up. And I'm not even sure what excess savings is really defined as. But the M2 is still really high. It's still higher than if you had taken that trajectory pre-COVID and just kept going. We're still substantially above that. And I think that has a lot to do with it. Plus, the leading economic indicators, which have been very reliable historically, they're extremely focused on manufacturing. You've got a fair fraction of them. And manufacturing was really strong in the lockdown. People were buying refrigerators and doing decks in their backyard, doing a home office and buying cars and all that stuff. But services were completely, major categories of services were just dead, travel, leisure, and hospitality. So when the manufacturing stuff rolled over, people started thinking, well, the recession, we're starting to check like every recession box. But the problem was they didn't understand that the manufacturing-oriented indicators, manufacturing-ism, the leading economic indicators, that got handed off to services. So suddenly when the economy reopened, we had a baton pass from manufacturing to services, and we actually had a boom in travel, a boom in hospitality, leisure. We had Taylor Swift and all this other stuff that actually she probably added a tenth to GDP. And so it's just that those patterns aren't really that reliable because the context is completely different. And I think that's what people missed. Now, some people, Danielle DiMartino Booth is on our Roundtable Prime. There's a video out where she says the recession has started. Now, I think she said that a year ago too, but that's a lot of people are leaning on that. So I think the probability of recession is higher than the consensus thinks. But I've got sucked into the mapping problem myself. I thought we would be in a recession by now, but maybe we are, maybe on revisions, but it just doesn't seem like it. There's this narrative that I hear a lot. I've even heard on the radio. Some guy said the economy is shrinking and inflation is going up. Well, he says, so that's the definition of stagflation. So we're in stagflation. I can't call this environment stagflation yet. First of all, the economy is not, we had 2 negative quarters of GDP. That was probably a little added to the confusion as well, right? But the last one they say is 1.6. GDP now is pretty unreliable at this early time in the economic reporting cycle for the quarter, but it's higher than 1.6 on that estimate now. And certainly this is not a really high inflation rate. We've had a very high cumulative inflation rate. So this is going to be that same problem of looking at year over year instead of over 3 years. I saw something interesting today that many food categories over the past 4 years are up 40 and 50% cumulatively. And some of them are up, 200, 300%. And so we just like we have a lot of M2, we have a lot of high prices. And people are still having problems with that. Mm-hmm. And so that might ultimately lead to, a real problem because people got used to this stimulus. They ramped up their lifestyles. They treated themselves. And a lot of them are out of money. And you can see it in credit card usage going way up, the number of credit cards going up. And I think Andrew showed the increasing delinquencies in various parts of the asset-backed underlying loans. So, I don't think we're in stagflation yet, but I do think that when the recession comes, it's going to be a very, very ugly experience because, and I talk about this all the time, but the federal deficit is over 6% of GDP, and the Biden administration predicts that it's going to be 6.1% of GDP for 2025. Well, I'm going to take the over. I'll always take the over on those things. And that means that when next time we go into a recession, historically, recession adds to the deficit 4% in the old days, 9% in the last 3 recessions. If you average it out, it might be about 6%. And the trend has been to be increasing. So it's plausible that we could have a deficit, at least for a year or two, of 12% of GDP. And that's really scary because we already have all of this debt that we have to roll over. And one of the things that I think we'll be talking about in a couple of years is that people didn't really prepare themselves mentally and investment-wise for all of these bonds that are rolling off that have coupons of 25 basis points, 50 basis points, 100 basis points. There's a lot of them. There's 17 trillion in the next 3 years that are rolling off. And they're not going to be reissued at 25 basis points, very likely. And if they stay where they are, higher for longer, if we just say that these bonds roll off with today's rate structure, you're talking about some of them being reissued at 400 and 500 basis points higher. And that's a lot. And now if you issue a greater amount with a deficit during a recession, you have a full-blown crisis on your hands because we're getting near that date that we have to cut Social Security benefits or restructure. They say, the CBO says it's 2034, but they assume 4% deficit of percent of GDP, 3% interest rates, and no recession. We're already well above that interest rate level, well above that deficit level, and the chance of having no recession by 2032 seems remote at best. So I'm going to say that Social Security runs out of money without a restructure by 2028, would be my guess. So we're getting very close to that. And one of the reasons I think the Fed is trying to find excuses and reasons why to cut rates is they've got to know about this. They've got to know that we cannot sustain rates at this level and enter a recession because the whole thing, we'd have to do what we need to do, which is restructure these unfunded liabilities that are not are sitting out there as promises to pay.
The Fed recently announced, I guess I'll call it a taper, a reduction of quantitative tightening, that is related to what you're talking about.
Yeah, I think Jay Powell went off script, not this one, but the one before. And he said something like, we need to get the balance sheet down so that we can inflate it again when we need to. He basically tipped his hand that, yes, the playbook is the same. It's you slash interest rates and you do QE, but he wants to do it from a lower starting position. Now, he's backed off of that one because we're going from 60 to 25 on the Treasury starting, I think, in June. So so he's not going to be decreasing it that much. But I think, he's aware of the fact that these things are issues, or at least he better be, if he's the chairman of the Federal Reserve.
I remember, I think I was talking to one of my colleagues this morning, maybe it was 2018, maybe 2019, you were talking about 6% treasury rates back when that was very unheard of. We're pretty close now when you think about...
It was pretty good. I think it would have been exactly right if we hadn't had the lockdown. Because we were headed there like 2018, 2019. There was a little bit of a rally in 2019, rates came down a lot. But I felt like we were on that trajectory. Then all of a sudden, we made up for that in 2022 in a very short order. We got up to, 540 or something like that on the 30-year. So it's pretty close to 6. So I'll call that a win. When I said they were going to 6 within several years, the general wisdom was that rates would never go positive again. That was actually what the narrative was in 2016. I saw an article on the Bloomberg Wire that really shocked me, and it made me get a light bulb above my head. And that was a guy said, rates will never rise for my entire career, and I have an intention of having a very long career. And I was like, uh-oh. Because whenever, in this business, like Sherman and I like to say, it never means imminent.
Right. Do you think we'll ever see negative yielding bonds again?
No. I don't think so. I don't know.
What do you think? So you alluded to 6% yields back when it was very unfashionable. Sitting here today and thinking about bonds and the fiscal issues that you mentioned, what is your outlook for bonds over the medium term? And we can pull it in.
Yeah, I continue to have the same template, and I think it's been largely working. And that is that once you start to get some ideas of slowdown or certainly a recession, we'll have a Pavlovian bond rally. Bond yields will fall because everyone thinks that that's the way it works. Again, I'm very sensitive now to being cautious and thoughtful when trying to apply past patterns to the future. Because when you talk about interest rate movements, when you talk about how the dollar acts during a recession, it's all been during secularly declining interest rates, which I think are over. And so we all think that the dollar gets strong during a recession. I think it's going to be very, very weak because of the response to the recession. So, yeah, I think we could see rates fall in a Pavlovian way, but then everybody's going to wake up and go, uh-oh, look at these policies that we're running in response to this recession. They're going to be worried that the interest rates are becoming stimulative and inflationary again, right? And they're going to be worried about these deficits, and they're going to be worried about what the response is going to be to those deficits. Which, I think it's some component of monetization. It's part of it, if not full on monetization.
We saw that in the 1940s where there was yield curve control coming out of World War II, and inflation at one point, I think it was double digits, and it was down at 0 and it was moving around. But throughout a good portion of a decade, there was explicit yield curve control.
That's absolutely right. And inflation actually had a brief moment at 8% when the 10-year Treasury was at 2.5%.
Yeah, exactly.
I mean, incredibly negative interest rates. And those things happen at turning points. And early in my career, Treasury rates were as high as 14%. And the inflation rate using the CPI for the 12 months prior was 4%. It had been falling. There was a 10% real rate of return available, and nobody wanted it. And we sort of saw the opposite of that a couple of years ago, where the inflation rate was, you tell me, some people say it was, CPI got to 9.1, but import-export prices were in the high teens, and yet the rate was at 0. And so it's weird how those types of strange relationships tend to occur right at the turning points. And so it happened in the early part of the 80s. I think it happened in 2021, 2022.
When you fold in your view on the fiscal issues and all of that, like as a fixed income investor, how do you structure a portfolio that sort of navigates through that? Maybe the answer isn't like buy the 30-year because something's going to happen. Like we did that for 10 years, but now what is it?
I liked the 30-year last October because I thought a rally was coming. But I don't like the 30-year because I think it's going to be very vulnerable to changing attitudes about U.S. policy. And so if you want risk offset, which you're in a world where I think you do, you might want to own, say, 5 and 10-year treasuries or something like that as a way of maybe going up in price if the bond market starts rallying. But as I think Cohen talked about, and pretty effectively, there's a lot of logic for sort of double B securities, maybe higher single B securities in the 3-year, 2-year, 5-year area, where you're starting with a high base rate and you get a spread on top of it. So that's a really good way to go. I like double B bank loans still. It's higher for longer. I don't think they're going to default. We've been adding a little bit to certain parts of the CLO market for the same reason. Floating rate, start with a high base rate. You're ending up getting 7-8% on some of these things. And so it's pretty easy to put together portfolios that yield about 1.5% to maybe, for a little bit riskier, 2% more than an index fund. And it's not that dangerous. It's not that risky. So the Fed is, we were in, I term it the fixed income dungeon for 7 years. We were just absolutely being tortured. You couldn't get any yield. Inflation was higher than the yield rates. The Fed was at zero forever. Spreads. I mean, there was a moment in 2021 where the only way to get 5% from fixed income, traditional stuff, would be to buy the junk bond index and leverage it 50% and hope for no defaults because they yielded 3.5%. And if you had done that, you'd be out of business today because you lost a fortune on the bonds, you were leveraged, and your borrowing cost is above your coupon. So you got a really big problem. So that didn't work out. But now it's more like it was when we started DoubleLine, maybe 2011, where you can do these risk offset things. You're getting paid on both sides. You don't have a lot of risk. And so fixed income has gotten very interesting again. And I think it's demonstrably cheap to most traditional equity investments.
Now stepping back a little bit further. So on the screen right now is just a look year to date at asset class performance. It shows equities are up, bonds are down for the most part. The U.S. dollar's up. Broadly speaking, most currencies, all currencies almost are down.
It looks like a couple of years ago.
It does, like 2022. And commodities are up a lot. Just thinking about, when you think about all the food groups right now, you said that, parts of the bond market or the bonds in general look pretty interesting. What do you think about global assets in general?
I'm getting more interested in commodities just in the recent couple of weeks, maybe month, because commodities tend to be momentum oriented. And so it's a market where if you're below the 200-day moving average, and if that's in a sustained decline pattern, you just step aside on commodities. And that happened for almost the past 2 years. But that's changing, and the commodities have been getting stronger. And that, I think, is becoming a more interesting place, which kind of led to what I think Luz was talking about with the commodities and so forth in some of the emerging markets. I'm not really gung-ho yet on non-U.S., like emerging market category, because the dollar is just too strong still for me. I would need that to really start breaking down, and it's done kind of the opposite. I mean, it's kind of fairly on the stronger side, and so we do own some emerging markets, but they certainly, I noticed those local ones sure did well with the Mexican peso last year. Right? That was 28.9%. I thought that was a typo, but that was incredibly strong. I do like. I mean, I think I like. When it comes to equities, I like long-term plays. I'm not interested in the flavor of the month. I'm interested in things where I think structurally you have an advantage. And I like India, although and this is a good time to buy India, by the way. It's not up very much this year because India is everything that China was 35 years ago. And they're going to have to reform. They have tremendous influx into their labor force coming over the next generation. And there's all kinds of manufacturing and technology, including AI, that is being relocated from China to Mexico and India. And so I like both of them, and Mexico and India. And I just kind of like Japan because I think they were dead for so long. There's a lot of room to make it up. And at least they've gotten out of their negative interest rate folly over there. They're in kind of a sweet spot. Yes, they have a huge debt to GDP, which is a big problem, but their rates they don't have the refinancing problem that we do.
Right.
Our rates are 500 basis points higher than theirs. So I kind of like those three as long-term plays. So I like for a total allocation, like 10% India, 10% Mexico, 10% Japan. And then we started an ETF here that's based on the Fortune 500 biggest companies in terms of revenue. And we equal weight it. And I never like momentum. It's just not in my DNA. And momentum right now is really, really had gone on a huge tear. So I like this equal weighted thing better. I could see having 15%, 20% in that to round out maybe a 40 to 50% equity basket. And I like, commodities could be your real asset play. Gold is getting along in the tooth. I think it's up $40 today. So it's just amazing. I liked gold. It was one of my number one recommendations for 2024, but I sure as heck didn't think it was going to go up from 25% in 3 months.
Do you have a speculation on why gold's on this run?
I think there's just growing awareness that developed country governments are completely out of control. And I feel it. I feel like the average person is starting to realize how the gravity of this problem, that we're running on a debt-based scheme with no end in sight. And I just think that people are starting to think that maybe I should own something that is real money. And that, it's probably not a coincidence that Bitcoin's up a lot too on a year-to-date basis. I think they're both part of the same phenomenon, but it's also the animal spirits were out there, NVIDIA, momentum, and Bitcoin certainly plays in that as well.
You mentioned earlier some of the indicators for the economy that, I would call what we're in right now some sort of post-pandemic cycle, which I don't know what that means. I just think it doesn't mean all the business cycle indicators that we used in the past are so useful. Do you think something or things change in the COVID period? I mean, for example, you mentioned India and Mexico, the de-Chinization, if you want to call it that, a little bit of move towards that, a little bit of more reindustrialization in the U.S. Do you think that these are long-term, more durable trends that shifted or peaked, however you want to think about it, COVID?
I think these are long-term trends that have been started. I do. I mean, we have a real problematic relationship with China right now, and you just ladle that on top of what we're doing in Ukraine, and similar but very different approach to the Israel-Gaza situation. We're in pretty deep on this stuff, and the Taiwan one could well be coming. So there's a lot of geopolitical problems, and that could be a significant variable in why gold is strong.
And you mentioned a couple. One of the questions I was going to ask is, we've talked about a lot of things. What do you see as the biggest risk? Is it fiscal deficits when you think about global markets? Is it geopolitics, or is there something that we haven't alluded to?
I think it's social. I think you're ostrich with your head in the sand if you think there's not social unrest in this country. I mean, it's breaking out all over. In fact, I decided to name my next Total Return webcast, which is June 11, 1968, because I was around 1968, and this is extremely similar, except this time the people who are protesting don't have anything to protest about. In 68, people were mad because they were forced to put on a uniform and go to Vietnam and kill people or get killed. They were forced to. So, and at that time, they couldn't even vote. You were 18, you couldn't vote, but you were sent off to Vietnam. I can understand why people want to protest against that. But the people today, they're not protesting against Israel in the main, in my opinion. And some of them, I'm sure, are. They're just protesting against how bad the world is, particularly if you're a college senior. You didn't have a high school graduation, right? You had 2 years of garbage college that you paid $90,000 a year for, and now you don't have a graduation ceremony, and you're starting to wake up that your degree in leisure studies is not going to get you a job. And so they're understandably, they feel like they've been swindled. And they sort of have been, because the baby boomers we're just, it's like born at the right time. I used to talk about this 15 years ago, and it's gotten worse. How much money our government invests in people over the age of 75 or 65 compared to how much it truly would invest in people that are 25 and younger. The ratio 15 years ago was 7-1. It's gotten worse. Now, that is no way to run a country. You should be investing in people that have a future and a stake in the future. You shouldn't be investing in all of these ex-hippies that are now running our government. And I find it ironic that the young people today, they are understandably mad at the 80-year-olds that refuse to go away. And they just keep running, and they stay in until they die in some cases. And they don't have any stake in the future, and they've screwed everything up. And they're getting Social Security, and they're getting Medicaid and Medicare. So why shouldn't I get my student loan canceled? I mean, it's always helpful to try to, instead of saying these people are ignorant and naive, maybe you should walk a day in their shoes and see what you think about it. I gave a couple appearances down at this thing called Future Proof, which is a very unique financial event. It's held at a beach parking lot down in like Huntington or Newport or something like that. And it's very much skewed to young people. I think most of the attendees are under the age of 40. And they were talking about politics at one of them, and I lamented the fact that there's all these old, ossified ex-hippies that are in the government. I said, why don't we have some sort of new generation? Why don't we put age limits? And when I said, why don't we put age limits on, I got a standing ovation.
When you think about what you just mentioned, how do you think that ties back into markets, the unrest, the discontent that you're talking about? How do you think that as investors, does that play out in fiscal deficits?
Well, yeah, I mean, I think the United States is going to have to restructure its unfunded liabilities. And that there's the conventional way that we'll try to do it. Like, okay, we'll means test Social Security. Okay, we'll raise the retirement age in some sort of staged way, which I favor. So if you're over the age of X, and I'll just make up a number, I'm not proposing anything. If you're over the age of 50, your Social Security is as is. But if you're 49, your eligibility age goes up by 6 months or some scheme like that goes down. And that'll be an attempt to get it under control, but it's the problem's too big. And so I'm thinking, so what would be a radical solution? What would be something that is completely out of the box? And I think we have a template for that, at least a potential template, and that was the modification of residential mortgages in 2007, 2008, because that was not allowed. There were securities that were backed by these mortgages, and the prospectuses of those securities said, these cannot be modified, but they did it anyway. And you're just out of luck. Just like the GM senior secured bondholders were subordinated to the pension fund. I mean, this is wrong. So maybe we'll restructure the Treasury debt. And I'm not proposing this, nor am I predicting this, but it's one way of thinking about the options. Maybe they can say, you know what? First of all, we're not paying back any foreigners. That's number one. Number two, so we're canceling that. We don't owe you anything anymore. And the next thing is, if you have a coupon that's 2% or higher, it's now 2%. And if your coupon is below 2%, it's the original coupon. And of course, that would be a total disaster. They would try to sell it as a one-off. They'd say, we know this is really bad. We'll promise we'll never do it again, which you got to watch out for that one. But what will happen if they do that is it will solve the problem for the future, because we won't be able to borrow for a generation or two. And so we'll actually have to have a balanced budget.
Right.
I mean, it's just amazing the extent to which people don't understand that you cannot borrow your way to posterity. You've been sold that shtick. You're coming of age. You've really become somewhat successful when you got approved by a Visa card, And that was like, I remember feeling that way. I actually got my first credit card. I got was a card from Sears, I applied for it and they gave it to me. I thought, wow, I'm coming into my.
Is this in the Hollywood apartment?
Yeah, it was actually the 2 apartments later when I had to buy curtains.
All right. We'll save a little room here for questions. I actually don't know how much time we have left. I have to admit that. What's that?
Go to questions.
Yeah. One last question, and then I will go to questions. What's the most important lesson you've learned during your career?
Begin every day and every strategy knowing that you're not going to be right all the time. Knowing that you're going to go out of business if you're wrong more than you're right. So you have to have a belief that you're going to be right more than you're wrong. And I can slice and dice 40 plus years of my record, and I'm right about 70% of the time. That sounds like a lot, but when you're at something more than 40 years, 30% you're wrong for over a dozen years. So there's plenty of years that I'm wrong, right? Because I've been at it a long time. But if you respect the fact that you're not going to get everything right, it changes your mindset to say, if this goes wrong, how can I structure so that it's not fatal? How can I avoid fatal mistakes? That's the whole thing. So it's funny when I get interviewed by journalists and stuff, they always say, well, you said that rates were going to fall and they fell by 200 basis points, so you were right. But how come you didn't own anything but the 30-year Treasury bond? That's how you go out of business.
Right.
Because that is so telling that journalist has never managed any money, doesn't know anything about the business, because you can't do that, because you're going to be wrong. And you have to be able to survive it. And that's where, a lot of these people, they just blow up because they're willing to go all in. I remember when one of the guys that blew up the bond market in 1994 was this guy running a hedge fund. His name was David Askin. And he made the unethical mistake, it was intentional, so it wasn't a mistake, of misrepresenting his strategy. His strategy was go massively long. And he advertised it as duration neutral. And then rates rose. And he lasted about 6 weeks into the rate rise and completely blew up. And I ended up doing a consultancy call with his clients. So they wanted some advice on what to do with this disaster. And prepping for that call, I talked to the guy one-on-one. And he said, look, I made a bet. If the Fed would have held off 1 year and raising interest rates, I would have made hundreds of millions of dollars. So he was intentionally betting the ranch. And I suspected, when you bet the ranch, I suspect you run into the 30% problem more than the 70% problem. Yeah, I suppose you could. I suppose you could, and that could be a non-conventional option as well. I've often wondered what would happen if the Fed bought all the bonds and then canceled them. What would happen?
Maybe we'll see in Japan.
Yeah, maybe we'll see in Japan. I mean, I guess you just restart. But the problem with canceling, with modifying the coupons and that sort of stuff is there's a lot of people that think that that's money that's coming. And what about the pension systems? You would collapse the pension systems. So yeah, there's all kinds of strange possibilities, but we can't keep doing what we're doing. And when I started this business, it was known to be a future danger, but it was perceived to be 80 years away. And then 10 years passed, and the debt was increased, so suddenly it was 60 years away. And then 10 years passed, and suddenly it was 40 years away. Well, now it's, per the trustees of the Social Security system, 10 years away, and they're being optimistic. And by the way, Medicaid and Medicare, could be out of money by 2030 using the CBO estimates. So it's getting to be crunch time, and it's going to be very, very interesting. I mean, people say, I've named myself Uncas, who was James Fenimore Cooper's last of the Mohicans. He was the last Mohican. When I started in this business, there were a lot of bond guys, and they're all gone. I'm the only one left from that era that's of any significance. And people ask me, like, well, I've done this a long time. Why don't you just hang it up? And I'm like, I want to see how this movie ends. and I want to get myself through it, and I want to help get my clients through it. And I handled the credit crisis better than any other fixed income investor in America by a lot. And this one's going to be just as hard. This one's really tough because we're going to have riots. We've already have a highly corrupted investigatory and judicial system. We've got RFK Jr., who's more popular than people think. And he's polling around 9%. It could easily flip the swing states. But I think that it's difficult for the incumbent president to not own social unrest. And Trump got tanked by social unrest, and Biden has to own the social unrest. And I think this looks a lot like 1968 when Johnson dropped out in March of 1968 because he lost in New Hampshire to Eugene McCarthy. And it was just shocking. I mean, I don't think he lost to McCarthy, but it was so close, people were shocked because the war was a problem. Well, the wars are a problem, and we have the social unrest. So I think Trump is going to win. Lots can happen with this kind of a volatile environment, but I think Trump is going to win. I don't think you'd find any buyers for it. I think the probability is very, very low. They should have done nothing but 100-year bonds in 2021, but they're too short-sighted, which is typical in politics, particularly Democratic politics, where you have elections every 2 years for the congressman. You know, it's sort of like, well, if we issued a 100-year bond, it might be at 3%. We borrowed zero. So we borrowed at zero, and we lost that opportunity. Now, if they issued all of that volume in 100-year bonds, it might have been 8%. I mean, who knows what the appetite is for it? But right now, I don't see it. My bias is to avoid the 30-year bond, let alone buy a 100-year bond.
I think last I checked, those Austrian 100-year bonds are down a bit.
80%?
Yeah.
I think they got to like 240 or something.
I think so.
Some ridiculously high price, but I think they're at something like 70 now or something.
Yeah, they're only 90-year bonds now.
Yeah, it's rise back. I had lunch with Henry Kissinger years ago, and he likes to drop names, and so he told me the story about he met the leader of China, and he asked him, what about Taiwan? And he told Kissinger, we are very patient. We don't have your political system. We can wait 100 years to get Taiwan back. And Kissinger said he met with him 30 years later, or his successor. Well, I don't know if it's the same guy. And he said, do you still have 100 years of patience to take over Taiwan? He said, the guy said, no, that was 30 years ago. We have 70 years.
That was probably 30 years ago too, right?
That was probably 25 years. So yeah, they're
rolling down.
They're down to 45 years. You know, their economy is so much stronger that they'll probably accelerate the timeline. Well, fixed income I would have at about 35%, and I would 15% in real assets. Gold was a good choice several months ago, but I think now it's just land is a good real asset to own. I actually never thought that I would own a second house, but I ended up buying a 1,200-acre timber ranch in Southeast. And so I think that's a phenomenal investment. I've got water, I've got protein supply. I can flip a switch and be off the grid, be 100% solar. I just think that's going to be worth a fortune. So I like stuff like that. do have models. One of them works really, really well, although it's not terribly out of consensus typically. But we basically make some estimates on a shelter, and we use the energy prices. And you get fairly accurate short-term readings from that. When I say short-term, it might be 3 months, 6 months. At the end of last year, that model strongly suggested that we were going to have inflation below 3 in the middle of this year, but not anymore. It's because the energy prices have gone up. And so now I think that's one of the main reasons why we have this change in attitude. It's hard to believe that in December, the market was pricing in 7 25 basis point cuts. I think you'll be lucky to get 2. In fact, I think it's going to be 1, based on where things are going. And if oil goes to $100, which it hasn't moved much lately, it's been centered around 80, you have no chance of getting a 2% inflation. I think Jay Powell he's done a couple of things wrong. The first was introducing Supercore, which did a Jackson Hole in, I think, 2022, because that was looking favorable at the time. Well, Supercore PCE is not so bad, but Supercore CPI is at 4.8% year over year. 4.8. That doesn't sound like 2. And the other problem is if you take those recent inflation prints and annualize them, this is the other mistake Jay made. He justified the November 1st rhetorical pivot by annualizing 3 months numbers and 6 month numbers. That became very fashionable in financial media at that time. Well, the reason to do that was that as of November 1st, annualizing those numbers, it was 2%. You had 2% inflation 3 months annualized. But that's not working anymore. And so that's one of the reasons that these cuts are going away. So, but we look at all of these things. We've come to look at inflation for the last 2 years rather than 1 year, the last 3 years. We look at PCE, we slice and dice all of them, annualize it, the whole thing. Sometimes they tell a consistent picture, but now the numbers seem to be skewing higher than expected. And that's further going to be propelled by if this commodity price turn has any legs to it. So I'm very skeptical. Jay Powell at this last press conference, I mean, I sort of like Jay Powell. I think he tries to be honest, but he does do a little prevarication. And he said inflation was at 2.7%. Of all the numbers you could pick, that's the lowest one. That's the PCE, the lowest number, 2.7. Supercore CPI is at 4.8. There's plenty of 3s and 4s out there, depending on what series you want to look at and how you want to slice and dice them. I have much less confidence than Jay Powell seems to exude that we're going to see that 2% inflation number during Jay Powell's term. In fact, we might not even see a single year over year with a 2 handle on the CPI. I think they're already there. I think Jay wants to continue to represent his approach, his ideas, not change them in the bottom of the ninth inning, because he's not good. He's going to be gone. I don't think he wants to come back. He's been there for a while, but he's certainly, if Trump wins, he's not going to be there. So, I think one of the ways that you deal with this debt problem is you run inflation. Like I said earlier on, I'll end it at this. Monetization will be part, at least a component, of the solution to handling this debt problem. And it's not just a U.S. phenomenon. It's happening in other places too. So you start having a global inflationary policy. This is why bond yields are probably secularly in a rising mode, which could probably last, like that fellow said in 2016, very long career. I can't have a very long further career. It could be reasonably long, but not long. I think that rates will rise in a trend sense for the rest of my career.